Just a few weeks back, Morgan Stanley is advising investors against buying the dip in Chinese stocks, warning that foreign funds may keep selling unless there is a further policy easing and sentiments is likely to remain fragile. So now, touch your heart, ask yourselves, how many of you are feeling the same? So it seems like foreign investors' outflow from the A share market, which is the mainland Chinese shares, has encountered an unprecedented stage, where the cumulative outflow of more than 22.1 billion US dollars is the largest in the stock connect history. Given this backdrop, most investors will be left wondering, what the heck should I do? So before anything, smashing the like button sounds like the best course of action for now. Anyhow, let's take a look at what the rest of Wall Street have to say about this touchy topic around investing in China today. So Thomas Tor, the head of APAC from BlackRock, says that while there may be some tactical trading opportunities over the coming months, a long-term overweight to China today will be harder to justify. In fact, China is no longer the powerhouse of Asian growth. That's moving towards places like India and places like Indonesia and possibly even Malaysia. So moving on to Jason, who's the fund manager for Jupiter Asian Income Fund. So he states that, and I quote, "We don't think there's a lot the government can do to stimulate the economy apart from perhaps a currency devaluation." So the government's default action in the past was to beef up infrastructure stimulus, but the dilemma now is that the country may have more roads and airports than it actually needs, unquote. Joyce Cheng, who's the chair of global research at JP Morgan, said that, and I quote, "This year, we think that the government will exceed the 5% growth target with the recently announced stimulus measures, but growth could actually decline to around 3% at the end of the decade," unquote. So it wasn't just a cyclical phenomena, but for many investors, it's a structural story. So China is not a mainstream holding right now. So yes, I've read out a ton of bearish views from Wall Street today. So what am I supposed to do? Sell everything now? Hold your horses. There are always two sides of a story. So let's look at what the other side has to say for now. So Justin from T. Rowe Price, who's the Chief Investment Officer for International Equities, believes that best investments are actually made just as you are feeling the most uncomfortable. And this negative sentiment around China today actually provides a contrarian investment opportunity. So the issues surrounding the Chinese property sector are structural and will cast a long shadow over the economy. Still, investors should not make the mistake of conflating economic growth with the equity market returns. As valuations remain low and sentiments hit an extreme, investors' interest will return to China as it has in past cycles. This sounds extremely familiar. I wonder who has the exact same thoughts. Moving on, George, who's a portfolio manager from Fidelity International, says those who have left China will come back once earnings start to revise upwards, and he is cautiously optimistic over the prospects of corporate performances in the next couple of years. China used to be the kind of the lower end sort of a manufacturing hub. Now, it's the batteries and the EVs. Opportunities are changing. Peng Zhao, who's the CEO of Citadel Securities, called China a driver of growth and innovation and said that it was baffling to think otherwise. So Wu Yibing, Temasek's China president, commented that, and I quote, "The reason we are still excited about China is because we have seen structural competitiveness," unquote. So Singapore's Temasek sees very attractive investment opportunities in China at the micro level, noting that the sovereign investor is still excited about China despite the headwinds. For those of you who have recently been affected by the TD Ameritrade closure or wish to essentially consolidate your stock holdings to one platform, you are in luck. So Weibo is actually here to help. They have recently launched their very first transfer-in deal. You can basically transfer your shares in for free as they subsidize your transfer-in costs and even earn US $750 worth of Tesla shares. So here's how you do it. You can first sign up with the link below and create an account. Then you download the app, register, and log in. So the approval process is relatively quick. Next, you can head over to the menu section and click onto the transfer deal banner and select participate now. Thereafter, you click transfer now and you'll be directed to fill in a transfer form. So to get the reimbursement on your transfer in fees, you will need to share the transfer record with the service team. So Weibo has also recently upsized their sign-up campaigns, and new users to Weibo can now create, fund, and maintain any amount in their Weibo account for 30 days and win 10 fractional shares worth between 100 to 5,000 US dollars. So if you sign up on your own, you will only get 2 free shares. So remember to sign up with the link below now. So a few points to take note in this transfer in campaign. Your transfer in should be minimally worth US $25,000. If not, it will be rejected. So you must also send in the proof of transfer out fees within 15 days from the day you click participate, and you must maintain a daily net cumulative deposit of above $25,000 to receive the $750 worth of Tesla shares. So the transfer in rewards is a new client exclusive, and I'll leave the terms and condition in the link down below if you need more information. So Weibo currently only support transfers for US stocks and US ETFs that are tradable in the Singapore app. So for those of you who have yet to apply for a Weibo account today, I think this campaign is extremely attractive to transfer in your shares. Do note that, however, this transfer in rewards can only be stacked with the new deposits campaign. And for those of you who do not wish to transfer your shares in, you can instead participate in the Money Bull promotion and still benefit greatly from their rewards campaign. So for those of you without a Weibo account today, I don't know what you're waiting for. Thank you Weibo for sponsoring this video. So after hearing from both sides, what is the conclusion? Let me tell you, I think these experts do not know too. So I've shared Thomas's view previously, who's the head of APAC at BlackRock, and how he finds it hard to justify a long-term hold on many of these Chinese positions. On the flip side, some months back, Mark, who's the head of BlackRock's global client business, said that the future investment in China is likely to be much more driven by capital markets, as individuals actually seek to diversify their savings away from property and also deposits. So those are big opportunities for us, and long-term, China has to be a part of a global investment portfolio. So that's a different perspective from someone in the same company. So who am I supposed to listen to? Both representing the same company, yet at the same time presenting totally opposing views. So let's get back to the basics again. A quote from Charlie Munger: "Show me the incentives and I'll show you the outcome." So what do these asset managers, investment funds, portfolio strategies, and Wall Street in general have in common? So they all want to make money. I think we are pretty clear about it. So the keyword here is to make money, and I didn't say it's for you or from you. Usually, there will be an official house view from the various banks where it will be the official position of whether the company, the bank, the financial institution, whatever. So within that mix, you actually have senior executives having their own personal opinions, which might sometimes contradict the company's view. However, the end goal is the same. They will throw out a bunch of different viewpoints, see which sticks, and come true in retrospect, and repeat the cycle to establish credibility and to convince even more investors to park money with them, and that translates to much more bottom line profits for the company. So you just have to be very clear of the entire incentive structure. So back to this investing into China topic. Look, I don't have an easy answer, and I doubt anybody has. So I know this might not be a very inspiring answer to many, but it's the best that we know of today. So if you really have the ability to look out into the future and know who will underperform and overperform, and be 100% confident of that certain outcome, then we will probably all be very rich in no time. So the fact of the matter is this: China is in a very tough environment today. There are many convincing stories built on their shaky economic fundamentals, from a real estate implosion to an aging population to the decoupling of the world and some sort of a deglobalization to the structural unemployment mismatch to the great power rivalry and so on and so forth. So I think the truth is usually somewhere in between. So it might not be as horrific or even devastating as how many of these doomsday prophet talks about China collapsing in 26 days or so. However, it's probably not an easy fix either, with just a press of a button and everything is back to normal. In fact, I do believe in this Chinese idiom, 富贵险中求. Wealth is created in times of adversity and in times of crisis. So at least to me, most people have essentially associated China to something being undesirable and basically a travesty over the last few years or even the last decade. Therefore, I've positioned my portfolio that reflect this current viewpoint of mine. Who knows whether I will be right or wrong? Only time will tell, but we all have to choose the hill that we wish to die on. Specifically on investing, sometimes too many people conflate economic data and perspectives with how the market is going to react and perform in general. So have you ever wondered why the richest people on earth are not necessarily your economists, but mostly people who invest or build businesses on their own? So there is a two-factor input in this game: the economic data itself and the consensus reaction towards the economic data. So people can always try to guesstimate the data for the first factor, but always underestimate the effects of the second. I continue to stay bullish on my positions. If not, why would I hold them in the first place? I believe fundamentally that the Chinese companies in my portfolio are some of the best in their class, and they will continue to deliver and exceed expectations. So the market in general can disagree, for now, using price action and demand supply. But in the long term, I believe many will be convinced otherwise. So a parting quote before I close off this video. So this is from Peter Lynch in his book One Up on Wall Street. This is investing, where the smart money isn't so smart and the dumb money isn't really as dumb as it thinks. So the dumb money is only dumb when it listens to the smart money.
I'm even more convinced now that the next China is only China. I think this year, when we look at around 5% GDP growth, roughly a third of the global growth in GDP, I think we're on track, right? And if you compare that with, around 1.5% of developed markets and around 4.5% of emerging markets, China is still way in good and positive territory. The question is why we're a little bit nervous about this, right? Because there are issues and challenges that we got to solve, right? And these are the housing we've talked about. These are some of the consumer sentiment, right? That is coming back a little bit. So I think from a long-term and growth perspective, I think we're on track. But in the short term, there's some expectations that we need to get used to, which I think is causing a little bit of the short-term, jittiness, right? And nervousness of people.